Hello, everyone, and welcome to another presentation by the Barry Flinchbaugh Center for Ag and Food Policy. My name is Eric Atkinson, and I'll be your moderator for this forthcoming discussion on trends currently in the U.S. economy, what they mean, what they signify, where they may be going. Before we get into our program proper, though, I want to remind you about the center itself. It was created in 2023, and it's to foster discussion and education on agricultural policy alternatives and their consequences. This via various means, including educational outreach, research, and scholarship. And many of you will recognize the namesake, longtime and widely renowned agricultural policy specialist at Kansas State University, Dr. Barry Flinchbaugh. This center operates as a vehicle for discourse on ag policy, much in the manner that Dr. Flinchbaugh taught and analyzed over his many years. Now, we do ask you to time check the website and see what it offers, learn more about the center. We'll discuss that further later on. Flinchbaughcenter.com is that address, flinchbaughcenter.com. What we're providing here is quarterly observations on the leading economic indicators in the United States, including several specific to agriculture and how they're trending. We're calling this the Flinchbaugh Focus, thumbs up or thumbs down on the economy. And we have a panel of three top agricultural economists to discuss each of these indicators, and each will give a thumbs up for a positive trend or a thumbs down for a negative trend. Very much in keeping with what was a long-standing series that Dr. Flinchbaugh and one of our panelists conducted over the many years, and we do want to introduce the panelists now. Mark Edelman is that one who interacted with Dr. Flinchbaugh in such a fashion. He is a professor emeritus in agricultural policy at Iowa State University. Also on board is Brad Lubin, agricultural policy specialist at the University of Nebraska. And Jenny Ift is with us, the Flinchbaugh Agricultural Policy Chair at Kansas State University. Welcome back to all of you. Hope you had a good summer, and we have more than plenty to talk about right here. So without further ado, we want to launch right into this and see what we have.
Hello, everybody. The first chart we're going to look at is the percent change in U.S. real gross domestic product. This is over the last 20 years, 2006 to 2025. So you can see that whole span of years there. Now, what really sort of stands out is the large changes during relatively short periods. So we had a decline in GDP during the Great Recession back in 2007, 2008, and then you can see COVID, where we had a sharp decline and then a sharp recovery. But in most years with GDP, you look at zero, that's the midline there. You have some growth, maybe 1%, 2%, 3% from the previous period. That's more the norm when we look across the past 20 years.
So how do you read that chart in as far as the direction of GDP and how it's trending? What does it portend for the future? Jenny?
Right. Absolutely. So if you look at the second to last quarter, it did trend negative a little bit. And then it sort of was trending upward in the last quarter. Both are well within the historic range if we look post-COVID or within the sort of the broader time period. So just with these most recent numbers, I don't see a major change from what we've seen historically with the quarter-to-quarter movements of gross domestic product.
And thumbs up, thumbs down, thumbs neutral, what are you thinking?
Well, I guess thumbs up for the time being.
Brad, Lubin, bring you in to remark on this chart. What are you seeing, and does it correspond with what Jenny is saying?
If stability is good, that's a thumbs up. I think in general, I sense we're trying to address a couple major questions here that we don't know the future of. When Congress passed the One Big Beautiful Bill and the president signed that back in July, there were expectations that there are substantial tax policy changes to lock in some of the existing tax policies that were set to expire. That should help promote future economic growth, at least be an incentive and a solid support under general economic growth. But we also have the uncertainty of ongoing trade conflict and almost seemingly changes from day to day and what direction we think we're going with trade. So there's enough uncertainty to leave me a little bit concerned, but at least for the moment, we seem to be holding water.
And a cautious thumbs up for you, Brad.
Call it a cautious thumbs up. Yeah.
Mark Edelman, your thoughts.
Well, I'll be the contrarian in this discussion. No, I think the last quarter, we've known about these tariffs and continued delays on implementation, much longer than what folks had anticipated last April when they were first announced. And so a lot of businesses across the country took some actions to beef up their imports prior to the implementation of a lot of the tariffs. And I think that's kind of one of the reasons why we have had sort of a surprising bump in GDP growth this second quarter, in my estimation. And so if we look ahead, we're just now implementing the big tariff rates. And for many of the tariff deals that have been negotiated, we don't know what the details are yet. But anticipation is that maybe the average tariffs will be 15 to 20%, which in my mind will slow down the economy, and we'll see the effects of that about the time that the big budget bill starts to take effect after the first October 1st, which is the beginning of the federal fiscal year, that it would apply towards. So I'm going to go thumbs down on the outlook for the next 6 months to a year.
So we've a split vote there. Thumbs down for Mark, Jenny, and Brad at a tentative or maybe a very subtle thumbs up. Let's put it that way. The next chart we'll look at unemployment rate. Brad,
You bet.
what do you see when you look at this chart?
To be frank, I see concerns. We see a 20-year running history here of unemployment rates and obvious peaks back in the Great Recession and then during the COVID shutdown. But what we see is that we're trending up from the sort of post-COVID recovery. We got down into the 3.5 to 3.7 range on unemployment, and we're trending back up. Sticky right now around 4%, 4.1, 4.2%. Frankly, some of this unemployment is by design, a little bit of effort to try and reduce government staffing and government agency levels. But some of this is also uncertainty in the broader marketplace with concerns about the direction of the economy. So a little concerning here, a thumbs down, really, on current unemployment, because higher rates are leading us in the wrong direction.
Mark, are you similarly pessimistic on the unemployment rate? You hear a lot of chatter, of course, somewhat regularly in the media and otherwise about this particular trait.
Well, I'm a little bit more, I don't know whether to call it optimistic or not, but I'm going to go a thumb sideways on unemployment, in part because we're still creating jobs at the same time ICE is deporting people. And so I think as we continue deporting people, that tends to put a downward pressure on unemployment by removing some of the labor force. So certainly there's a lot of uncertainty out there, but I'm going to go sideways on my thumb this time.
Jenny, your thoughts?
I'm going to go sideways as well. I think this could trend higher. It's been around 4.1, 4.2 for several months. If the trend is indeed upward, that is concerning. Obviously, there's a lot that's going on underneath this number, but I think we really have to wait and see how it plays out over the next several months.
All right. So it's one of those situations where uncertainty is prevailing. We're going to hear that a lot more, I think, as we go through the rest of these indicators. The next one we'll talk about, and we'll let Mark set us up here, the Consumer Price Index. We look at this chart, and we see a trend upward on both lines. Talk about that, Mark.
Well, yeah, the top line, or the green line, is the Consumer Price Index, and it continues to rise at about 2.7% at an annual rate, or essentially in July, it showed a 0.2% increase. I think the inflationary pressures As I look out forward 6 months or so, the tariffs are going to create some bottlenecks, I believe, on imports to put upward pressure on prices. We've seen the producer price index, particularly for food and feed, which is the bottom line, trend up a little bit more quickly the last couple of months. And so I'm going to go thumbs down on inflation, thinking that we're going to experience continued inflationary pressures that will discombobble the Federal Reserve a little bit. They try to shoot for 2%, and we aren't there yet at this point. So I'm thumbs down on inflation.
Jenny, your take on this?
I think that increasing producer price index is a concern, and it really feeds into what we've been hearing about this profit margin squeeze for crop producers.
Brad, what Jenny says is really echoed throughout the countryside. That's a common theme among producers, the cost of doing business.
Right. Well, I would give these both a thumbs down too. As I look to the future, the producer price index might actually seem like a positive. This is the price index for producer output, ag products and food and feed products. It's not a cost index for producers, so higher looks better, except that higher ag product prices translate into and push higher consumer prices over time. And Jenny, as you noted, I think the higher PPI index is almost entirely due to livestock, and maybe even more particularly due specifically to cattle, which are enjoying some record prices and amid very short supplies. So there's pressure there, and it's not widely benefiting the broad ag sector, but yet it's pressure on future consumer prices. So a concerning signal here.
It's down, in other words, presumably.
It is.
All right. We'll move on to the next one. Before we do, I want to just mention something here that I intended to say at the outset. The Flinchbaugh Center does have a special event coming up later this month, and we'll be talking more detail about that at the end of our podcast here. So be listening for that information. It's going to be a great gathering, and you'll want to know more about it and possibly be part of it. We'll give you the details in just a few moments. Jenny, would you talk about the federal funds rate?
Yeah. Here we have the effective federal funds rate. This is a measure of interest rates. Again, 2006 to 2025. It reflects the rate at which banks and other lenders can borrow funds, and it has fluctuated a lot at near zero levels for a while after the Great Recession, went up again before COVID, went down during COVID to near zero rates again. And then after 2022 started going up quite a bit as a part of the Fed's mandate to reduce inflation. So we have seen interest rates come down recently, which is lowering the cost of credit. But it does, I guess I would say underlying that, there is some tension because the Fed's trying to balance interest rates with inflation. So right now it's an ongoing debate whether we're going to see continued declines in interest rates or they're going to keep them relatively high to counter inflationary pressures.
So how would you rate this particular trend? Is it another sideways, wait and see situation?
I think for me, I'm gonna go sideways, wait and see. I think, there is political pressure on the Fed to lower rates. The Fed is trying to uphold its mandate to balance inflation and interest rates. So I think, I like to look at this from the lens of, is the Fed going to be able to balance that? And I'm going to go sideways because we kind of gotta wait and see how that plays out.
Bad interest rates are always front and center in all economic discussions, it would seem. How do you read this chart?
Right. I'm reading more of an impact, and I'm concerned about a thumbs down here in terms of what it really means for agriculture. I agree, Jenny. The Fed has to balance its independent mandate and sort of stand back from political pressure to try and create easy money. But it's at what are, at least over the last 20 years, relatively high interest rates. They are still, if you have a much longer look back, they're still relatively modest, but they are high by any sort of recent comparison. And so it's putting much more pressure on borrowing capacity and debt service that at least raise issues of concern. And as long as we see these rates holding where we're at, we see some negative repercussions for agriculture.
Thumbs down for you.
Yes.
Mark, you in concert with that?
Well, it's a tricky question. I would say because I don't think interest rates are going to go up in the current time frame. I think they'll either stay the same or the Fed will give in to, and maybe give in isn't the correct pressure. They'll follow the data, and if the data says that they ought to, that there's flexibility to lower interest rates, they will. I think the bigger issue that I'm concerned about regarding the Fed is maintaining the Fed independence, because I think that has a lot of long-term policy implications that, and where the country is headed. We've had an independent Fed for decades, and I would hate to see us give up managing the economy for the economy's sake rather than having it shift gears based on political whims. And so I'm going to go sideways at this point, too, with uncertainty over which direction we go. If the Fed caves to presidential pressure in this regard, I'm going to have a serious thumbs down on the issue.
The Fed's independence is very much a hornet's nest, and we watch that from day to day and week to week as well. The next one we'll look at here, the level of government spending and the surplus or deficit or both. And Brad, well, we talk about this frequently too, commonly. What are you seeing in the latest chart?
Well, two things that always show up in this data. In modern history, data back to the 1970s, governments have generally been running a deficit, so much so that we call it a structural deficit, and consistently, but it's consistently also getting bigger. The bottom line there on the chart is the balance, federal receipts or federal expenditures minus, federal revenues minus federal expenditures, and we're negative and we're trending down. And 15 years ago, amid the Great Recession, we jumped to like a $1.5 trillion deficit, and we talked about that being a record. Now we're only hoping to get back to something close to a $2 trillion deficit. That's sort of the changing environment that we're living in here with government spending. After the COVID era balloon in government spending and increase in we recovered a bit, but we've recovered only to a trend line that continues to get higher and higher. And so it's a thumbs down because it's not a signal yet that we have any sort of sense of control over the direction of government spending and the amount. And we have increasing pressure. Heck, even interest costs are now going to be the single largest budget item for the federal government to deal with. So it's an increasing challenge. This year's budget reconciliation process just proved how politically challenging it is. And that's something we're going to continue to have to work through.
Do you concur with that thumbs down analysis?
Yeah, I do concur with Brad's analysis and give a thumbs down on government deficits. With interest payments rising to over $1 trillion a year, and rising because each year we add to the deficit, we add to the public debt. And so we have to pay more interest, which is not a discretionary payment. We have to pay the interest. And so it's been rising, and it's reaching a point where it's crowding out the other normal spending that we would normally do as a government entity. So yes, thumbs down.
How about you, Jenny? You make it 3 for 3 on this one?
3, absolutely, thumbs down. So yeah, spending keeps going up, and to really get spending under control, you have to cut the military, Social Security, Medicare, Medicaid. Interest rates are a big part of our payments now, but I don't think that we have the consensus in the country that would really create the political will to tackle one of those to the point where you could really start seeing a noticeable decline in spending. So thumbs down.
Across the board. Mark, tell us about the current exchange rate for the United States and what it's signifying.
Well, as we look at what's happened since the chart shows since 2006, we had sort of a lull in 2012 in which we were down to about 80% of the index number, and now we were up to about 115, and now we're down to about 1 108 in terms of the index. So the dollar's been weakening some in terms of a broad basis. So it really doesn't show a reversal of the upward trend yet, except in the recent few months that we've headed downward. But if we continue on the downward path, it does make our exports less expensive for foreign customers as the dollar becomes less expensive relative to other currencies. It makes, again, imports for U.S. customers more expensive. So it kind of adds a little bit to the inflationary pressures. And then you add to that sort of the global currency exchange questions that are currently going on in the broader debate and how we monitor the exchange rate and what are going to be the uncertainties of adding additional currencies that we've never really had experience with before in terms of cryptocurrency. It just adds a lot of uncertainty to the current situation, in which reason the dollar has been strong is because a lot of the wealth around the world has felt that the U.S. was a safe haven for placing its currency in U.S. dollars. And with the realigning of world trade and world coalitions, that becomes more uncertain. So even though the overall trend is kind of upward there on the dollar, I'm kind of thinking that the dollar's going to come down and probably help out exports to some extent, but it'll be offset by other factors. So I'm going to go sideways on the value of the dollar.
Jenny, your observations here then on this?
I'm going to go sideways with Mark as well. Again, with, generally the sort of exchange rate moves up or down. Some groups, exporters benefit, importers hurt. As an economist, there's also this, just, is the exchange rate accurately priced? And I think the sort of the sideways is, what are the implications of this realignment? Is the U.S. dollar going to be seen as a reserve currency? And that's where I think that's just going to have to play out over the next several months to see what the implications of that are.
Brad, farmers are hoping that the lower value of the dollar will move more product at the very least amidst their low cash prices that they're receiving, at least on the crop side. So pretty important indicator here.
It's an important indicator. I unfortunately have to give it a thumbs down because I look for further weakening of the U.S. exchange rate, or at least those are what the questions in front of me tell me. Farmers may actually appreciate a weaker dollar in the short run because it theoretically makes our products more price competitive. Although with tariffs in place and with some political repercussions of the ongoing trade conflict happening in terms of trade flows, maybe making ourselves more price competitive in export markets isn't going to fundamentally change the picture anyway. So I'm a little bit concerned about where we're going, and more so of, look at that last 15 years or so there, or last 10 years at least, of a strengthening dollar, even as we've had continued growth in U.S. Trade deficits. That's a function of foreign partners willing to hold and interested in holding dollars, much as Mark said. Holding dollars as a safe haven, as the strongest currency across the globe. If we re-examine or shift our thinking on the U.S. dollar as the primary reserve currency, or if we shift enough trade flows that the dollar no longer dominates trade as it once did, I could see sort of a sizable shift in terms of the future for the U.S. dollar and the uncertainty it brings. I don't have a prediction of how far and how fast, but I see more concerning signs pointing to a weaker dollar going forward than signs to support a continued strength of the dollar.
That is a good segue right into our next indicator, the total value of U.S. agricultural trade. Your observations here to get us going on this one, Jenny.
All right. So this is the dollar amount, total value of U.S. trade. Both imports and exports have been going up over time. But in the past few years, we've seen that imports are higher than exports. So you have that, agricultural trade deficit. And this data only goes to 2024. So, 2025 is not over. There's still a lot to be seen. Is China going to buy soybeans questions like that. So I think it's kind of good that we wait until 2025 is over to assess where we're at. So if I have to I think to sort of, take into account the broader context, I'm going to have to be thumbs down for this one. I know there's a lot of trade deals that are going on. You look at our biggest partners, though, China, are they going to buy or not? Japan, the EU, Canada and Mexico are huge. I don't see, with some of our major partners potentially pulling back and maybe not the potential growth from some of the other ones. I think there's a lot of uncertainty here.
Brad, that's back with us, that word uncertainty. That seems to ring very true here.
I have to share the same unfortunate sentiment, Jenny. I don't have as much concern about the U.S. ag imports line. That's been a fairly steady increase and growth over time. And fundamentally, U.S. ag imports include a lot of complementary products that we don't produce but want to continue consuming, as well as products that help increase sort of the throughput and efficiency of even some of our own food manufacturing, like beef trim to support the processing side, or even live animals to support our feeding and processing sector. So I'm not as much concerned about the import side. It's the export side that has taken a real hit. Even so much to the point of it's kind of hard to figure out, can we get any deals? As Jenny noted, will they have an impact, or have we sort of fundamentally started to shift away our ag sector from a global focus to a more of a domestic consumption focus? And that remains to be seen, but at least the trend for the moment leads me pointing down.
Mark?
Yeah, I go thumbs down too. I think Brad hit it right on the head there, where, the president said earlier a few months ago that U.S. farmers should look for more domestic uses for their production. And I think that heeds a little bit of his call, because it looks like exports are going to be a real question mark as we move forward. So I'm going to go thumbs down ag trade for this year.
Well, how is all of this then playing on the farm or ranch as we take an updated look at inflation-adjusted net farm income? Brad, there's the chart. What is it saying?
Well, here is actually a rather interesting and sort of mixed signal, which has me pointing sideways, maybe first time, whichever direction sideways is here. But look at the top two lines in the chart. You have crop receipts and animal and animal product receipts. And they've really been trending opposite directions for the last 4 years. After crop receipts neared or sort of equaled their record in 2022, they've been trending down steadily since. And that's pulling down farm income prospects and cash flow and farm financial position along with it. Livestock receipts have been relatively strong, close to record levels, and sort of sustaining that. Fundamentally, that's cattle going to the moon, so to speak, and other sectors sort of enjoying various levels of stability or recovery. Eggs had a year up and then a year down, and so on and so forth. But it really is a tale of a farm and a ranch, so to speak. The farm sector, the crop sector looks to be challenged. The livestock sector on the ranch looks to be enjoying some fruit here for the moment. But net cash farm income is actually relatively strong. It's close to record levels in real terms, and that's built on the strength of those livestock returns relative to crops. It's also built on government payments, and a substantial bump up in government payments here in 2025 due to emergency assistance passed in 2024. So the combination of some one-time government payments, which don't really promise us much long-run certainty, coupled with some record prices in the cattle market, which seemingly can't last forever. Those are the two things it takes to sustain farm income for the moment, which leaves me thinking sideways on the future.
So, Mark, you have mixed indicators here. How are you reading this as far as the overall farm income picture?
Well, I think the big positive thing that we've seen, whether or not they can deliver it, both the Secretary of Agriculture and the President have said they're going to take care of farmers by providing a bridge. And so, but they've been saying that for several months now. And I think that ag interests across the country are going to continue to have to weigh in on that issue until the bridge is built and actually operating. That's an important element here. Otherwise, those last two upward trend items in terms of net cash farm income and government payments, if we go forward, if there isn't government support, then net cash farm income's gonna be downward in pressures. Cautiously optimistic. We'll see whether the president and the secretary can deliver on their promises.
So a sideways and a cautious thumbs up. Jenny, where do you come down on this?
I'm gonna have to go sideways as well. I would like to note with those sort of you see those high government payments in 2025. Those are indicated to be for losses in 23 and 24. And this is something when you have these kind of ad hoc as needed payments, they don't always come for any number of reasons. They don't always come in the year in which the losses are occurred. So that net income number, those government payments number would look a lot smoother other side. So it's kind of almost and it's not false, it's real, but it's the upward movement is slightly misleading. And there has been talk, there is potential for another round of emergency payments in 2025. That'll have to go through the political process. So we could see that as well.
We shall see. But looking at something that talks a bit about the longer-term stability of our farms and ranches, the farm debt to cash flow ratio. Mark, there's the chart upcoming here. What are you seeing?
Well, this one's one that's really hard to interpret, because if you think about the ratio of debt over cash flow, if the number is going up or the trend is going up, then that means the debt is increasing more rapidly than cash flow is. Or vice versa, if it's going down, then that means that debt is coming down proportionately more rapidly than cash flow is going down. And so here in the last year in this chart, it shows that the debt to cash flow ratio has been coming down. Now, as we go into the future, I have some concerns that that debt would be increasing perhaps more rapidly than cash flow will be. And that would tend to indicate that there's more financial stress that's in the sector than before. I always, though, try to remember that only about 23%, according to the last ag census, 23% of the farmers have farm debt. And so we're talking about a portion of the farms that are out there that are really under potential farm stress as this ratio would increase. So I look for this ratio possibly to turn around and go up rather than to continue on the downward trend.
As of right now, a thumbs up or sideways or what?
Well, I would say if the trend goes up, then that means I'm pessimistic for the ag sector on financial stress in this case.
Jenny?
So I think I think right now with what we're seeing with crops and livestock moving in different directions, you do really need to interpret this one carefully. But I think that, cash flows in there, and that's going to reflect what we're seeing in cattle. But I know that for crop farms, debt repayment liquidity is an ongoing issue, not universally, but that is something that I am definitely worried about. The other thing is, I don't think these numbers capture the full amount of farm debt that's out there. You do have increasing demand for vendor finance, private finance, alternative financing right now. So this is something where I think I'm more sideways to down. There's a potential downside that we're not seeing, but it's, definitely the sort of liquidity loan repayment's going to continue to be an issue for crop farms, or at least, a fair number of crop farms, unless we see expenses come down or stronger prices or some combination of the two.
And Brad, your thoughts here? Something somewhat dramatic will have to change to make this a more favorable longer-term scenario?
Well, yeah, it would take some substantial changes here to substantially change the trend. I think I'm with Jenny. It's sideways to concerning down. As a sign of overall strength of the ag sector, it's a fairly stable picture. And we know that the broad balance sheet for agriculture is really still very strong. But as noted, it's not about the overall sector. It's about the sector that actually is borrowing money, or it's about the difference of the crop versus livestock sector and which one's facing more financial pressure at the moment. If you focus in on those particular sectors, then debt to cash flow is a real burden right now. Cash flow concerns are a high priority for management. So it's a little concerning. The broader picture is much more stable.
Well, a very important underpinning to the farmer ranch economy would be farmland values. And that is our last indicator that we'll examine today, U.S. inflation adjusted farmland values. This is in dollars per acre. And Jenny, will turn to you to talk about a trend that has been somewhat in place for quite a while now.
Right. And yeah, we've seen steady increases to farmland over time. The USDA NAS, they released their August land values report, and we did see that, farmland values, cropland and pasture values are growing, continue to grow. They're holding up against inflationary pressures. So I guess for me, that's somewhat of a cautious thumbs up. I think what it, shows out there is there's people that are still interested in buying farmland. And I think, the majority of that is producers who, whether these are more, producers who had some good years a couple years ago, so they still have a lot of cash in hand, or these are, like older, more experienced producers still buying land. You also have a lot of outside interest in cropland and pasture land. So I think that's what's going on here, but it could definitely change over time.
Add your thoughts here, because if there were a dramatic drop suddenly, that would be catastrophic for a lot of agricultural producers.
Yeah. Well, yeah, I think interestingly, we see these relatively steady increases in both cropland and pasture over the last few years. Cropland markets have seemingly digested two different trends at the same time. Crop economics has been going downhill for several years. Granted, we know that land is a much longer term investment than just a single year to year change. So they got to smooth that out. But cropland returns have been going down for 4 years plus. And at the same time, the attractiveness of farmland as an investment tool continues to be really strong. So it's supported the overall market. Eventually, I'm thinking it has to reflect underlying ag economic returns, and that's going to put pressure on cropland and pasture land maybe over the long run. But for the moment, I'll call it steady.
Your take, Mark?
Well, yeah, I'm surprised that we continue to see the steadiness in land values. I would have predicted maybe a soft. So for that reason, those who invested in land are still in good shape. So I'm going to go thumbs up on land ownership.
Well, so we've covered a number of indicators here, and each has an importance to the big picture, and that's what we'd like to finish with, if we could. Have each of you give some cumulative comments on these trends and just the state of the U.S. economy in the broadest sense, and then the agricultural economy as we head into the fourth quarter. Brad, let's start with you.
Well, if I summarize and I think about where I've been voting here during this discussion, I'm unfortunately pretty pessimistic. A lot of things I have concerns about pointing in the wrong direction right now. The general economy has still managed to move along relatively strong for the time being at a steady course, but faces growing uncertainty, and almost every specific component that might plug into that looks to be a concern for me. On the farm sector, net farm income as well is sort of carrying along for the current year, but it's clouded with a bunch of uncertainty in terms of the future direction. So I hate to be the pessimist out of the gate here, but I see more concerning signals than promises right now on the horizon.
Jenny?
I'm gonna have to go with a similar sort of. I think there are potentially a lot of headwinds for agriculture with the general economy. There's a lot of uncertainty. If cattle weren't doing so well, it'd be pretty pessimistic across the board. But I think on the crop side, farms are carrying. I mean, farms have been adding debt over the past 2 decades on average for the ones that do hold debt. So you have high debt levels, not necessarily unsustainable, but you have farms going into this situation with trade uncertainty, general economy uncertainty, with relatively high debt levels. So I think a lot of uncertainty, but there's a real downside here, depending on how things play out over the next couple of years.
Mark, you have the last word then.
Well, I'm trying to look for some bright spots, and as I think back over what we talked about today, I think that I've always recall Flinchbaugh saying that land markets are kind of like an antique market. We aren't producing any more of it, and there's less of it available each year, and that perhaps continues to surprise me that we haven't seen any more softening of land values. So that tells me that people are still where they have their investment in agriculture and land. That's has been and will likely continue to be a good investment as we move forward. You could probably argue whether or not the rise in land values have made us a little bit uncompetitive, but perhaps if we have a readjustment in exchange rates, perhaps that'll help make us a little bit more competitive. I guess the uncertainty over trade and the general economy, that we've followed a strategy of trying to use tariffs to better our own America First set of economic circumstances. We're going to find out what the outcome of that is over the next year. And right now, I would say that for every action, there is a reaction. And we're starting to see how people around the world, the leaders around the world, are going to react to that. The terms of trade in the agreements that have been negotiated haven't been fully revealed. Supposedly, though, there's some good nuggets in there for agriculture. And so it remains to be seen how that's going to affect the economy as it's unveiled this fall. But I would also say that the tariff dollars that have been collected, we better start figuring out how to create that bridge to a shock absorber in the ag sector, because that's going to be needed as we go through the next year. So that's where I'm at. A lot of uncertainty, as you said, but there's still some nuggets out there that I think that we can hold on to.
Well, we'll have plenty of fodder for discussion when we gather later on this year. Actually, it'll be in early 2026 to discuss the fourth quarter trends. Panel, thank you very much for your insight. We greatly appreciate it. And before we go here, we do want to preview a special event that is set for Friday, September the 26th in Manhattan, Kansas. The Flinchbaugh Center for Ag and Food Policy is inviting each of you to, in effect, step into the classroom of one of the Ag's boldest voices, Dr. Barry Flinchbaugh. This will be at the inaugural Flinchbaugh Forum. It is again happening on Friday, September the 26th. The venue will be the Bluemont Hotel in Manhattan, Kansas. This is designed in the spirit of Barry's legendary K-State lectures. It's a one-day event. It'll bring together producers, policymakers, economists, and industry leaders. This is expected to be a bold and unfiltered conversation on the future of agriculture and economic policy. Very much straight talk with real-world impact, and there'll be a lot of the Flinchbaugh-style candor that goes on during this event. By the way, the day will close the way Barry would have wanted it. We'll have a drink in hand, and we'll toast his legacy. For event registration, again, please check out flinchbaughcenter.com, and you can follow the center on Facebook and LinkedIn. That date is Friday, September the 26th at the Bluemont Hotel in Manhattan. We hope to see all of you there. It'll be a great gathering for one and all. Again, we would thank our panel, Brad Lubin of the University of Nebraska, Jenny Ift of Kansas State University, and Mark Edelman of Iowa State University for offering their thoughts. Also want to give a nod to the executive director of the center, Dana Woodbury. She is serving as the producer of this podcast. Great credit to her as well for this effort. Go to flinchbaughcenter.com to learn more about the center and its rapidly growing mission. You'll want to be part of it. And be watching for our next Flinchbaugh Focus, thumbs up or thumbs down on the economy, in early 2026. Eric Atkinson here. Thanks for being with us.